Hello, my name is Jennifer Ashley, and I am Univest Foundation's Plan Giving Officer. And I would like to welcome you today on behalf of Univest Foundation. Just to start, I want to give you a little bit about Univest Foundation. Univest Foundation was established by Univest Corporation in 2003 with the goal of helping individuals with gift planning and helping nonprofits with developing or expanding their planned giving program. Today, our panelists will be really focusing on the advice that your donors receive about potential gifts when you're not in the room. So they're going to be focused on some planned gifts, but also some major gifts that might happen today. But before I introduce these great panelists, I just want to give a few housekeeping items. The first thing is that this session is being recorded and all participants will be muted during the session. If you do have a question, please enter it in the Q&A box. Our intent is to leave some time at the end of the session to answer your questions. No guarantees we'll get to all of them, but we do hope to answer those questions at the end of the session. Well, since you're all muted, there's no need to tell you to silence your cell phones. So I'm going to go right into the introductions for our speakers. First, I'm going to introduce Roy Kershaw. Roy graduated from Drexel University with a BS in accounting. He joined Baum, Smith, and Clemens in 2003 and is now a tax partner with the firm. Roy's experience includes tax planning and compliance for corporations, individuals, partnerships, and fiduciaries. He also has extensive experience in resolving federal, state, and local tax issues for businesses and individuals. Roy's community involvement with the Lenape Valley Basketball Youth Organization helps keep him focused on the future. This involvement has also taught him that communication, teamwork, creativity, innovation, and flexibility are important qualities which he strives to bring to his work. Thank you, Roy, for joining us today.
Thank you.
Lisa Shearman is a principal at Hamburg, Rubin, Mullin, Maxwell, and Lupin. She has over 20 years experience advising and implementing sophisticated estate plans for clients that focus on business continuity and succession. She aims to reduce taxes and preserve wealth in the way her clients desire. Ms. Shearman has a substantial track record of successfully representing beneficiaries of estate and trusts in will contests, trust disputes, and guardianship matters. Lisa is a fellow at the Montgomery County Bar Foundation. She serves on the board of Montgomery County Estate Planning Council and the Wills for Hero Foundation. Lisa received her law degree from Widener University. Yes, Widener. And her LL.M in taxation from Villanova University School of Law. Welcome, Lisa.
Thank you, Jennifer.
Our third panelist is Eva Victor. Eva is the Senior Vice President, Director of Wealth Planning for Girard, Univest Wealth Planning Division. Eva oversees the financial planning experience for Girard's clients. She has more than 25 years of experience as an attorney in the financial services industry, as well as extensive knowledge in estate, trust, and wealth transfer planning. Eva looks at each client holistically to provide thoughtful guidance and customized plans aimed at addressing their financial objectives. Eva earned a Bachelor of Science in Economics and Finance from the University of Scranton, a Juris Doctor from the Dickinson School of Law, and a Master's of Letters and Laws in Taxation from Villanova University School of Law. Great to have you here today, Eva. So for today's format is our panelists will be telling us how they would advise the donors in a few different scenarios. Each panelist will be responding from their area of expertise. Questions for all the scenarios will be taken at the end of the session. So as we get into this, panelists, are we ready to jump into this first scenario?
Absolutely.
All right. So I'm gonna jump in there, hopefully. There we go, our first scenario. Meet Bill and Betty. Bill and Betty are 73 and 71 years old. Both retired last year. They've been approached by the local food pantry, for which they have attended the annual fundraising dinner for the past 10 years, to give $75,000 for complete pantry renovation and to consider a bequest that would fund upgrades and food purchases well into the future. They do want to help the pantry. They also need to revise their estate plan now that they are retired and have gained 3 grandchildren since the plan was last updated. Bill has used part of his RMD from his IRA to give a gift to his alma mater. Could give more. Betty has not decided whether to start withdrawing from her IRA. They plan to have some cash available from the sale of their home because they are downsizing significantly. 2 years ago, their son convinced them to buy $1,000 in cryptocurrency, which they're not sure if they should hold on to or not, and they have no idea what it's worth now. Betty's also considering a gift to her alma mater right now. They're approaching our experts about whether they may afford to give to both the alma mater and the food pantry, and the best way to make bequests and still be able to leave money to their 5 and possibly more coming grandchildren. So for this scenario, we are assuming that Bill and Betty have filled in the comprehensive intake that each firm that our panelists represent would have asked of them. And this would be a new question that they're coming to now that the food pantry has asked them for a specific gift. So I'm going to ask each of you, now that these clients are coming back with this gift option, what you would first ask them. So Roy, is there a question that you would ask them right now as they're sitting in front of you?
Certainly, Jennifer. As you had mentioned, I think we're assuming that we have gone through a very detailed analysis of, number one, their financial position and their ability to make this gift, and analyzing all of their assets to determine whether or not one asset may be more appropriate than another, or perhaps more tax efficient, because we have a lot of tools which we can make gifts with right now within the IRS's tax code. One of them is a qualified charitable distribution. And as the scenario suggests, Bill has already started doing this. There is a limitation of $100,000 per year per taxpayer. So Bill could do 100,000 and his wife could do 100,000 if they so chose. So assuming that this is an area which they might consider, that would be one of the questions that I think that we would start posing to them. How much is in your IRA? How much would you be willing to gift? It's a good tool because the required minimum distributions, which will be starting back up again in 2021 after they've been delayed for a few years. IRAs are growing in value as the stock market increases, and there's a huge amount of wealth in IRAs that when the required minimum distribution gets calculated each year, it's going to be a big number for some of our wealthier clients. So it's a good opportunity to use the qualified charitable distribution as a planning tool, one, to reduce the value of the IRA, and two, to reduce the tax impact. So what the required minimum distribution used as a qualified charitable distribution does for the taxpayer, instead of reporting that required minimum distribution on their tax return as taxable income, they get to exclude it. It's not a deduction that goes on to Schedule A, but it's income that they normally would have had to pick up on page 1 of their 1040 that they're allowed to exclude as a charitable distribution. So it does two things. One, it takes care of their required minimum distribution for the year, and it comes out without having to pay any income tax on it. Again, to clarify, it's not in this case, it's not a charitable deduction on Schedule A because they're not including the income on page 1. But in the past couple of years with the new Tax Act, they've increased the standard deduction to such a large amount that a lot of our clients aren't itemizing. And we're finding that to be able to use the qualified charitable distribution in conjunction with the standard deduction, affords them a great tax benefit. But you really have to do planning over a multiple number of years and to be able to maximize that. So I think that would be the first question that I would ask from a tax perspective, having all of the other information already in front of us.
Thank you for that. I would like to go on and ask Eva, would you have any question for these donors?
Well, I would like to echo Roy's comments about our assumption that prior to having this conversation and engaging in any design or implementation of a charitable giving plan, that we've conducted appropriate fact-finding and discovery to make sure we've discerned the client's, for instance, personal income and capital requirements in pre and post-retirement years, considering their assets, liabilities, current and anticipated sources of income and expenses, as well as their overall planning goals and priorities. So through that process, I would hope that we would clarify or maybe ask them to articulate and rank their top planning priorities, goals, and concerns, so we can try to match the most appropriate strategy to what they tell us.
All right, so with that, I'm going to tell you that their answer to your question about their top 3 goals is they really want to ensure that each of them can live modestly but comfortably in the case of a long-term illness or death of the other spouse. They really want to provide for their grandchildren, those they have now, and they're thinking they might have a couple more along the way, specifically for the grandchildren's college education. They want to continue giving generously now, if at all possible, and they would definitely consider and would love to give some legacy gifts along the way. So as you think about that, I'm going to go up to Lisa and say, would you have any questions for these clients as they approach you?
So Jennifer, I think, a good starting point here is just to point out that when we're addressing clients' questions and needs, it's so important to have the other advisors available, because we're all asking different questions, but the way that they answer their questions may impact what planning we decide to put together. And I am a big advocate of a team approach. So I just wanted everyone to be aware that when any type of gifting or donations are being considered with a client, that they consult with their financial, tax, and legal advisors to make sure that everything that they're doing is in accordance with what they've worked together with. So with that in mind, I've benefited now from the questions that Roy, has posed with regard to the taxes, and Eva's posed with regard to their goals. And that would be sort of some of the same questions I would be asking. What are your ultimate goals? What are you trying to achieve? And how best can we get there? So from my perspective, an additional question that would be asked, because I want to make sure that there is sufficient funds. 73 and 71 are young, and we want to make sure that they have enough to sustain themselves. So I think one of the first questions I would ask is, what are your expenses? I mean, it appears from the fact scenario that they must have a pretty good amount of either savings or other income, because they're gifting some of the RMD of bills. They're not even started taking any of Betty's. Now, Betty would have to start taking at age 72, or I guess April 1st of the year following the year she turned 72. So if if those aren't what they're relying on to live, I think that they could be potential assets to use for a variety of reasons. But that would be one of the first questions I would ask is, what other expenses are you anticipating? Do you maybe have long-term care insurance in case a health issue arises, so that we can better assess, whether they're going to need the money or, it'll be available to make gifts.
Okay, thank you. So they're going to come back to you and they're going to say, they are downsizing. They're moving to a 55 plus community, not a continuing care community. And long-term care insurance, they've always been really healthy. You know, their parents died at 100 and 102. They don't need that. So as they're thinking about that, Roy, you've already answered a little bit about the tax-wise, you know, that RMD sounds like an attractive option. So Eva, I'm going to ask you from a wealth planning perspective, is there anything that you would recommend for Bill and Betty as they're thinking about making their best gifts?
Yeah, again, focusing on the IRA as a potential subject of the gift, I think there might be potentially a good testamentary strategy for them to consider. They've also mentioned that they want to make sure that their grandchildren, both current and future grandchildren, are well provided for, particularly with regard to any educational costs and needs. So my thought is another potential planning opportunity for either or both of their IRAs could involve a testamentary charitable remainder trust, CRT. We know that following enactment of the 2019 Secure Act, the stretch deferral option or life expectancy payout option was effectively eliminated for many individuals inheriting IRAs. So most IRA beneficiaries, including their grandchildren, would now have no more than 10 years of income tax deferral, whereas in the past they may have been eligible for life expectancy payout. So a tax-efficient testamentary solution for the IRAs could include establishing a charitable remainder trust at the time of death or perhaps second death under their will or living trust, which could be the designated beneficiary of those IRAs. They could certainly name each other as the primary beneficiaries and wait to establish this strategy upon the survivor's death. Or the survivor could even disclaim all or a portion of an IRA to a CRT if desired. So the testamentary CRT could represent really an attractive alternative to a stretch IRA, allowing a named income beneficiary of the CRT, such as a grandchild, greater opportunity for continued income tax deferral beyond the 10 years of deferral they might otherwise be confined to. So Betty or Bill would designate the CRT, which is an income tax exempt trust, the beneficiary of an IRA upon death, eliminating all income in respect of a decedent, eliminating the IRD. The account would then be liquidated, undiminished in value, and then reinvested on behalf of, let's say, a grandchild who would be the term or income beneficiary of the CRT. And then they would receive a fixed percentage payout from the trust for the remainder of their lifetime, which of course they would pay income taxes on. But essentially they'd be spreading out their distributions and their tax over their remaining lifetime, rather than being forced to take a distribution no later than the end of year 10, if they were to inherit that asset. And then at the end of their lifetime, the CRT term would expire and the remaining value would pass to charities designated by Bill and Betty, which could include their respective alma maters, the food pantry, or any other qualifying charity, income and estate tax free, of course. So
Wonderful.
Go ahead. It could be a nice substitution for the loss of the stretch IRA opportunity for those beneficiaries who wouldn't qualify for it.
Wonderful. Thank you. Lisa, as you're looking at them and they're saying they want to revise their estate plan, would you have any suggestions for them regarding the gifts?
Well, I do like Eva's idea of a charitable remainder trust. I think that makes sense. And an alternative potentially to that would be the I would say flip, but a charitable lead trust. So if you were trying to get money to the charity more immediately, like the food pantry, you could set up something that has an amount that would go to the charity first, and then potentially would either whoever they name as the beneficiaries, such as maybe their I know they have at least one son. I'm not sure if they have other children, but their grandchildren could then be benefited in that regard. So I think either one of those vehicles accomplishes some of their goals. I would agree with Eva also on the use of the retirement qualified monies to for the planning purposes of what you're trying to distribute out to your family as well as to charities, because there's just a greater tax benefit to the extent that the money is paid to charity rather than it's inherited from, you know, Bill and Betty, either by their son or by their grandchildren. As Eva pointed out, their son would be at a point where he wouldn't get a stretch IRA because we're all going to presume that he's over 26. Hopefully doesn't have any disabilities. And the grandchildren don't qualify, even if they're under age 26, because that's, you know, that's how the Secure Act was set up. So they would have, I mean, you know, potentially depending on what their income tax rates are, and I think Roy could probably, you know, give some more insight on that. You know, there is something to be said for, and of course, who knows what the income tax rates will be then, but you know, that they would be in a lower tax bracket potentially, if you were to leave it directly to them, but they have to have it all out within the 10-year time frame, and then would be subject to, you know, the RMDs would cause them definitely probably to be pushed into a higher tax bracket, but once they have it all out in investments, then, you know, they could redirect. I would also point out that the cryptocurrency, you know, at this point, and I do not follow, you know, the ebbs and flows of the cryptocurrency, but there is potential there if, you know, if it continues to appreciate as much as, you know, people are thinking that, and again, it would all depend on, you know, how they want to do it, but they could maybe set that aside with the intent that those funds could fund the gifts to their alma maters, or potentially set up some type of pledge or scholarship type of gifting to do some, you know, lifetime gifting, and then maybe follow up with a testamentary gift as well.
Wonderful, thank you. Roy, do you have any last comments on this scenario? Anything now that you've heard Eva and Lisa's comments? Anything you would add?
I think they're all valid points. And again, we would have to go back to the fact pattern of the client, what their desires are, where they want to be in certain stages of life, and what their priorities are with the gifting, and when they want to do it, and how they want to do it, and what their priorities are, and try to tie things all together. As I mentioned previously, we have a lot of tools in our tool belt right now to be able to perform these charitable contributions. And these we brought out 2 or 3 of the top ones in my book. Probably the most useful one that we have, and it's easily done, is the gifting of appreciated stock. If they had any publicly traded stock, that could be another option to do the gift to the pantry and satisfy their gifting, their charitable intent. But yeah, there's a bunch of different ways to go, all depending on what that client profile looks like.
Wow, thank you. I do want to ask, and because Lisa kind of hinted at this, is there any point, and any of the 3 of you can answer this, that you would bring in either the directors of advancement from the alma maters or the director of development from the food pantry to maybe see what kind of gifts they were truly looking for and what would work for them?
I mean, I think that's a key component, because even, I mean, under the fact pattern, they're asking for $75,000, but, you know, and I'm sure if they gave them 75,000, they would, you know, invest some of it and use, as it indicates in the fact pattern, to do some renovations and continued upgrades into the future. But it may also be beneficial to have, you know, a tiered or, you know, structured payment of those funds if they wanted to do some over their lifetime and after death. So that would be, I think, important to have a conversation and have them included in all the planning related to making that gift.
Thank you. Roy or Eva?
I would agree those comments. I think it's important for all key advisors, including the donor's personal estate planning attorney or accountant or CPA, financial advisor, and of course the representative of the intended charitable organization, to coordinate their efforts and their expertise and work as an integrated team in order to achieve really the best result for their mutual client and ensure that the intended plan comes together the right way. Each professional plays a distinct and essential role in the process, and each person is really in a position to offer their unique perspective regarding the donor's circumstances and needs. And I think the earlier in the process that all involved parties are engaged and communicating with each other, the better the result for the client is going to be.
From my perspective, I think that the more, if they're thinking about doing something other than a cash gift, I think the charity probably doesn't care if they get publicly traded stock or cash up front. They're getting cash. But if you're doing some type of trust, whether it's a charitable lead trust or a charitable remainder trust, that may be an area where you want to bring in the charity to get some kind of feel for, hey, do they want to pay out going forward now, or are they looking for something on the back end? I think in that scenario, yes, you most definitely need to have input to see, one, if the charity's goals are matching the client's goals. But ultimately, it's the client that we're representing, but we want to do right by them by whatever their goals are. And then the charity would be second nature.
Wonderful. Thank you. Well, I think we're about ready to move on to the second scenario. Do want to remind everyone who's listening, and if you have any questions about this scenario, feel free to put it in the Q&A box, and we will leave some time at the end to address those questions and questions about maybe the other scenario as well. So moving on to the second scenario, we are going to meet Deb and Dan. And they're a little bit different. Deb and Dan live on Deb's family's 25-acre horse farm with currently 7 horses. They made a living training show horses and building jump equipment for horse shows. At 78 years young, they are considering retiring and moving to Tennessee to live with their daughters who race champion racehorses. 10 years ago, they had gifted 5 acres of land to a neighboring animal rescue, which has made it known how much they would appreciate more land. Developers have also made offers on the land, but no serious discussions have ever really occurred. Their training and equipment businesses are separate S corporations, which they do want to sell. Their son is interested in the house, but is no interested in the horses or the businesses. Deb and Dan are also considering setting up a foundation to help Olympic equestrian hopefuls. They want to know from you how to retire without being a burden on their children as they age, and they want to leave a legacy of generosity. And again, as with the others, we are assuming they've come to your firm and that they have come to your firm and that they have made a full intake, and that you're knowing of them, and this is something new. They've suddenly realized at 78 it's time to retire, and so they'd like to do that. So Eva, what would be a question you would ask them as they're sitting down in front of you now at this point of retirement?
Again, I think I would ask them to rank their primary or key planning goals, concerns, and priorities, just to make sure that we're making an appropriate choice of not only the asset to give, but also the particular strategy or vehicle in order to do so.
Thank you. And as I ask the other questions, I want you to think about their answer. They really want to preserve the house and the family, or maybe even as a historic landmark. It's been in the area for about 100 years. They also do not want to burden their daughters with their care as they age. Even though they're healthy now, they know that might not always be the case. They do want to create a legacy gift, and they're really leaning on those Olympic hopefuls now and doing something with them or helping them. Giving the land to the rescue is a lower priority, to be honest, because they didn't feel like the rescue was a good steward of the property. And since it's their neighbor, they've kind of watched how they've been stewarding it. But they do know the rescue does great work and might want to consider a gift to them. So as we think about that, I'm going to go to Roy. Any question for them?
I guess a couple of questions. Have they ever considered gifting any appreciated stock, if they had any, in order to accomplish some of these charitable goals and priorities? You mentioned stuff about the house and how they may want to preserve that. They could consider giving that to the historical society or something of that nature, or for the land, maybe a conservation easement. There's a bunch of different tools that they could explore, and whether they have thought about those.
Okay. They have considered all of that. They're also considering, you know, their son may want to live in the house, whether it be for his life or, you know, if he ends up having children, for his children to live. And so as we're thinking about that, Lisa, would you have any questions for them?
And I apologize, I keep putting myself on mute. They decided to start cutting the grass right outside my window. So it's been very loud. So again, mine kind of focused back on, I'm trying to make sure that they're taking care, they're thinking of themselves, and their needs, and, you know, and looking at, alternatives. I mean, if they were to, it sounded like, you know, that their careers or their time spent has been on this farm and with these horses. And so, I mean, we can make the presumption that the family property was inherited, has probably little to no basis in it. And so, you know, to the extent that they, you know, would sell it, and maybe to the developers, and, you know, of course, depends on, you know, how much it would be worth and what they pay, but, you know, you have to take into consideration the significant tax issue that they may run into. So a donation to charity is definitely, I think, preferable, possibly, but it also depends on what else do they own. Are there, you know, it doesn't, based on what we believe, I don't believe they had qualified accounts. Of course, they'd be entitled to Social Security. But I would be asking them, you know, what other assets do you have to sustain, you know, your lifestyle, and then we could make a better assessment on, you know, whether this, you know, some of the ideas that we have will work.
Thank you. And before we ask Roy exactly what tax issues you want to consider, they did want to inform you that, you know, they have the horses, and these are valuable horses that they've been using. So the horses, they consider them an asset. They're worth between 10 and 20,000 each. So they're looking at that and thinking, you know, maybe to sell them or move them to Tennessee. They might want to think about your opinion on that one. They do agree that the businesses and the farm are all debt free at this point because they've been inherited and have really no mortgages or anything like that on them at all. So looking back at this information, Roy, what are some of the tax issues that Dem and Dan need to consider, especially in regard to those S corps that they're holding?
Well, I think they need to, you know, the timing of any of these charitable contributions is also something to be considered when you have the sale of the S corps, and depending on what they think they are going to net, how much of that do they want to keep? How much of that do they want to give away? Timing the contribution or any type of planning would ultimately want to be done within the same year, so that the sale could be offset by some of these contributions and planning that could be done in order to minimize their tax burden. S corp stock is hard to give away. It's not publicly traded, so that's probably not an option. So they're probably going to have to go through the sale of the business, and then try to find a way to mitigate the tax impact of that, and maybe make some gifts with those funds.
Okay. Thank you. Lisa, as you're looking at the estate plan for this couple, they're not exactly youthful. Would you have any recommendations for them?
Well, first of all, I would say that anybody who might be on here at age 78 will probably disagree with you on the youthful comment, but but no, I understand what you're you know, getting at. Is, yeah, I mean, they, you know, they are retiring and entering a phase of their life where, as you mentioned, they're debt free, and but they have obviously these, you know, long-term care potential issues. even with the most healthy of individuals. I mean, sometimes things come, happen. So we wouldn't want to, essentially give away all of their assets and leave them, with what they think would be an appropriate amount to live on. And then it turns out that one of them runs into a health issue, and now their daughters are tasked with their care and responsibility. And so definitely we want to make sure that that's taken into consideration in whatever plan that we develop. I think from, there's a whole bunch of different pieces that you need to take into consideration. I mean, I know that their thought is that they don't want to burden their children with, what to do with the property if they were gone. So they're trying to handle that issue now. And if they were to, make a gift of a very low basis asset to a charity or potentially to the foundation that they would like to set up for the Olympic equestrian hopefuls, that would be an excellent asset. But it's a 25-acre farm. There may also be issues with that. I mean, if they're in Pennsylvania, which I'm assuming is where the farm is located,
yes.
Yeah. If they're under a 319 covenant, which a lot of our agricultural farms and such do, they potentially could end up with the charity could end up with an issue if they then try to sell the property because of the 319 rollback. If they were to maybe if they were to essentially gift the property to the son along with the business interests, there are some exclusions in Pennsylvania that could sidestep the inheritance tax. But it sounds like the son doesn't really want to maintain the business, and he would be required to do that under those provisions. It's kind of hard, I think, if you're going to give the property away to retain an interest for the son. Like if you were to do a life interest to the son with the remainder interest to the charities, I mean, that's possible, but I think just because of the breadth of the property and the amount of work that's involved, I'm not sure that would work out. But that would be something obviously we'd have to have, a conversation with and discuss. So, I mean, as Eva had mentioned in the last one, I mean, we often use trusts in this situation, whether we use like more of a charitable trust, or we just set up a trust to assure that son's taken care of, that eventually that there's the charities are benefited, that along with some other vehicles might be good in this scenario. And of course, they don't have the foundation set up at this point. So the question would be, do they want to create a foundation currently? Do they want to do that at death through their estate planning documents? So that would be something else that we would want to, consider.
Great, thank you. Eva, how would you make these potential gifts happen, or do you think they could happen?
Yeah, a number of challenges which were mentioned, but assuming we have the right asset, an appropriate asset to work with, and given their maybe ongoing income needs, as they proceed through retirement, and the needs of the survivor, potentially, a charitable remainder trust could be a solution, to help Deb and Dan ensure their financial provision for themselves as, the term or income beneficiaries of the trust, as well as ultimately fulfill their charitable objectives, providing for the animal rescue or another public charity, or maybe even funding their private foundation upon their deaths. They could be the joint life income beneficiaries of the trust. And then ultimately the remainder interest would pass to whatever charities that they would favor. But, again, that's presuming that we have an appropriate asset to contribute, to that trust.
Thank you. I just want to circle back. Is there any question that either the three of you would have? Is there one fact in this scenario that would really make you skeptical about recommending a current gift for them, whether it be to start the foundation immediately or to give to the animal rescue. Anyone have any comments on that?
Well, I think it goes back again to, what could they gift? I mean, if they're going to sell the horses and they now generate $70,000 to $140,000 of, available assets, that might be able to kickstart a foundation, or potentially just, give money to the rescue. It sounds like the rescue really wants more property. And, one other thing, again, it's hard to know, but one thing that, would need to be considered, and we would have to consult even our real estate team, because it's not something that I, work with directly, but can the property be subdivided? If the property could be subdivided, maybe you could, portion off a small part for the son with the house on it. It sounds like the other charitable beneficiaries would like anyway the land for the horses and the other animal rescue. So that might be something to consider. Is that something you can do? There is also if they make a gift to their son, they're not going to pay, I don't know the value of the property, but if they make a gift to the son, there's no transfer tax on that. But if they make a gift to the charity, there is. So, that could be sizable if the property has significant value.
Thank you. Roy or Eva?
I think from my perspective, would all come back to our original preposition, is that we would have a complete workup on this client as far as their assets, liabilities, and just to make sure that they are financially able to do what they want to do to get their goals accomplished. I mean, without that, as long as everything came through, I don't think there's anything that would preclude me from telling them not to make any of these contemplated gifts. But it's an overall, and as Lisa and Eva have both mentioned, it's an overall team plan. You have to get the attorney involved, the wealth advisor, and the accountant to figure out, where are they in their financial life? Have they budgeted for everything? Do they have their future taken care of as far as potential medical issues with the long-term care insurance? And once you get all those pieces in order, it's easy to make the decisions. And then it's just up to how the client wants to accomplish that. Do they want to go with a charitable remainder trust? Do they want to go with a private foundation? Each of them has their places in the plan, and they each have different cost values too. The private foundation is going to be very expensive to set up, but if you have someone that has significant wealth and wants to leave a lasting legacy and is passionate about certain charities, it's probably a good idea. But I think it all comes down to the overall plan and structure and that fact gathering.
Thank you, Roy. Eva, did you have any comments before we moved on to the last scenario?
No, I think it does, just to echo Roy's comments and Lisa's comments, I think it really does boil down to maybe some deeper discovery and fact finding to discern what other assets they may have, what other concerns they may have, and that's really going to be our guide in terms of choosing the most appropriate asset to give and the vehicle through which to do it.
Okay, well, thank you. I am not seeing any questions popping up in the Q&A, so I'm going to move right on to our third scenario. Again, participants, if you've got any questions, go ahead and submit them through the Q&A, and we can still leave some last few minutes before we end, and as we talk about this last scenario, which is a little bit different. Third scenario, we're going to meet Martha. Martha never married. She has decided to give to multiple nonprofits over the year. She gives about $100 a month to those nonprofits. The last 10 years, they've been given all from her donor advised fund, which she had set up 10 years ago. She has 6 of those nonprofits, which she dearly loves, that she's going to give over $200,000 to after she dies as beneficiaries of the donor advised funds. And these nonprofits are very much aware of her gift. She has a will set up, which names about 25 nieces, nephews, grandnieces, and grandnephews who are going to receive a percentage of the remainder of her estate. She also has a fully paid life insurance policy of $100,000, and that's going to be left to her executor, who is also, by the way, a nephew. Martha lives in a senior living facility. She has Social Security and her pension as in her income right now, and her estate, which is mostly securities and municipal bonds, is valued at $3 million. She comes to you. She thinks she's got everything set, but now she's coming to you because one of those nonprofits, one that will not benefit from the donor advised fund, has approached Martha about making a gift, a significant gift for a program that she'd been donating to for 45 years and volunteered with for 25 years. Martha is very wise and she listens to everything that's being said around the facility where she lives, and she's heard some great speeches about selling life insurance policies and making those as gifts. And she's wondering if maybe that's the best way to make a gift right now and just include this nephew who's going to be the executor, just add him in as one of those beneficiaries of her will. So she's wondering if that's a good idea. And so I am going to start this time around with Lisa. Lisa, would you have any recommendations or questions as she sits before you?
Well, I think that, I mean, some of the analysis that would need to be done after looking at the plan that she has already structured is where are the funds coming from that she's trying to get to everybody. So is there sufficient funds in the donor advised fund to fully fund the gifts that she wants to make at her death, keeping in mind that she seems to be making continuing gifts, although at 85 her life expectancy would indicate that wouldn't be for 20 or more years. So so that would be part of the question and analysis that I would have. And also how she has the structure set up for all these nieces and nephews. If you were to say, okay, her estate's worth $3 million, and and it's divided equally among 25 individuals, they're each going to get 100 and X, it's hard to know because you'd have to do all the figure out all the taxes, but in excess of $100,000 each. And is the other one nephew part of that group, or is he, as the beneficiary of this life insurance policy, being taken care of separately? So that anyway, you'd want to try to keep things, as I would think anyway, as equal as possible so that everyone is taken care of. So the question would be is, where are all the sources of the funds coming from to meet the goals that she wants to meet? And then is there room potentially to withdraw $50,000 or direct $50,000 from her donor advised fund to be able to give to this current charity? Because I want everyone else to have a chance to talk, but I'm not a big fan of selling the life insurance policy under this scenario. I mean, there is a lot of use in doing that, but because it's essentially tax-free money and you have beneficiaries who are in a 15% inheritance tax category, and may also have to pay additional taxes, I like life insurance for those uses.
Very good. Thank you. Roy, would you have any comments here?
Yeah, I agree with Lisa wholeheartedly about not using the life insurance for this particular scenario. One, cashing in the life insurance or selling it may have it be a taxable event for her. And if she has $3 million of municipal bonds and securities, there has to be some appreciated stock in there that she could give away to satisfy this $50,000 gift. That way she would avoid any tax on the appreciation in that asset. And using the life insurance in this scenario just doesn't make any sense to me. Like Lisa said, there's a lot more uses for the life insurance, but in this scenario, I would think that there would be another source where she could make that contribution from, and it would probably be, I would recommend appreciated securities, some publicly traded appreciated securities somewhere along the line if she had that option, and she'll get a current deduction for it. She's not getting a current deduction for the donor advised fund contributions. That deduction all comes up front. So when she made that contribution years ago, she got a deduction then, but as the donor advised fund distributes that money out, it's not a second deduction. She got the deduction when she originally put the money in the donor advised fund. So that would be my thought.
Okay. Thank you, Roy. Eva, at 85 years young, she doesn't really need any money to live on. Doesn't look like she's a great candidate for wealth planning. So how would you approach this situation?
Well, first of all, I'd like to just kind of echo both Roy and Lisa's comments about the life insurance and the potential role life insurance might play in her charitable giving intentions. We're told that she has an existing policy. We don't know how large the policy is, how big the death benefit is relative to her other assets, like her securities portfolio, but that's certainly something we'd want to investigate. But it appears to be a fully paid up policy requiring no more premiums, no more burdens on her cash flow, so to speak, to keep this policy sustained. One thing I would caution her about is if the policy is in a gain position and she were to sell or surrender the contract, she could have significant ordinary income tax that she would have to report, assuming that the policy value at the time of surrender exceeded her basis, basically her premiums paid. So we wouldn't want her to incur, significant ordinary income tax. If she's borrowed against this policy, if she's borrowed against the cash value and the contract has an outstanding loan, that could also be problematic from an income tax standpoint if she were to sell or surrender the policy. She would have to recognize ordinary income to the tune of the greater of whatever her gain or the outstanding loan would be on the policy. And then, she'd have essentially the surrender proceeds net of any taxes that she could use as either a gift to charity or ultimately a gift or a bequest to her heirs. So my thoughts are keep the policy, in force and think in terms of who the appropriate beneficiaries should be on the contract. Let's say she's inclined to give her securities portfolio to charity, either as a lifetime gift or, as a testamentary bequest. By naming her intended heirs, her nieces and nephews, the policy beneficiaries, that income tax-free, inheritance tax-free death benefit they would realize upon her death could help replace perhaps the value of a significant charitable gift and preserve their inheritance, to help maybe equalize the sums that pass to charitable and non-charitable recipients. Or alternatively, she could make all or a portion of the death proceeds payable to one or more of her favorite charities, or even to a donor advised fund, and leverage or amplify the charitable legacy through that means.
Wonderful, thank you. So again, I want to come back to that question. At what point you have a charity that's asking her to make a gift, she's already been making gifts for a while. At what point would you maybe loop that charity in and say, what is really the intent of your gift, or what is the purpose of this? Would you recommend that she do that, or would you bring that charity into the conversation? Anyone?
I mean, I think, as we've all, as you've seen, we're all taking different approaches and looking at things from a different perspective. I'm going to be a little bit more focused on the death taxes, Roy's definitely, and so is Eva going to be more focused or, have on their minds the income tax ideas. And so I would think the charity, and if depending on, how structured it is, may have counsel of their own who can make recommendations with the information that they have that's going to be the most beneficial for them as well. So I think definitely they should be included in the conversations, just to make sure there isn't something that they don't want. I mean, in this case, it seems like, everything would be you know, able to be made liquid. You know, I mean, everything is there's not any non-liquid assets that she's considering or it seems to own. But I mean, again, there are important considerations to make.
Okay. Thank you. As we look at this, I just want to ask if there's any last comments on this. Maybe if you had reached Martha sooner, I'm assuming you all weren't the people she went to originally. Was there anything that you would recommend maybe to make this happen in a different way? Just as we close up, we have about 2 more minutes left. Any last comments on that?
I think it's kind of hard to,
Yeah,
know where
that's
to
a hard
get
question. Yeah.
started with. I mean,
We're
maybe
2
she
minutes
sold the
left, Lisa.
business and donated that all to the, you know, donor advised fund. It's hard to know. So
That's a great answer. Yes, thank you. Roy or Eva?
Yeah, again, I think the comprehensive review of the client data would bring out that type of answer. You know, the life insurance, you know, when did she get the life insurance? Does she really need life insurance at this age? When did she get it? It's fully paid up, so she's probably had it for a while. But I think a lot of the donor putting the money into the donor advised fund, when she got a deduction for that years ago, could it have been better done if she had spread that out over a few different years and planning that way? Especially in today's environment when they've changed the standard deduction to such a large amount that individuals can do what we call bunching of their itemized deductions, and they can itemize it 1 year and do the standard deduction another. You know, she may want to make a lot of contributions to the donor advised fund in 1 year and itemize that year, and then in the next year she doesn't do as much and she takes a standard deduction. There's a lot of different functions and interplay here that need to be looked at. But again, it's just coming down to getting all the client data, getting all the other professionals involved, and to see what's the best way to get the stuff over to the charity. And if there's an option as to what they want to gift, whether it be the land, a piece of land, or some of the stock, well, at that point, I guess you would probably get the charity involved and say, what do you prefer? Do you prefer the land or do you prefer the stock? And so that would be my final comment on that.
Thank you, Roy. Eva, any last comment?
Yeah, I think all of the strategies that we have discussed are really some good preliminary solutions to bring to the client's attention. And I think we just maybe need to probe a little bit more with some fact finding, and then, you know, adjust the recommendations accordingly as we learn more about their situation and interests.
Wow. Well, thank you all so much. I'm not seeing any questions, but we have only about 30 seconds left in our time. So I just want to thank Eva, Lisa, and Roy. Thank you so much for sharing your knowledge today. You've really given us all a better understanding of the depths of the issues that donors are facing when they come to you and what they're looking at, or maybe what you're looking at as well, that the donors hadn't seen as options, or maybe the donors hadn't seen as pitfalls. So just thank you so much for that. You know, it's always easy to say, hey, we should be making or asking for a gift from this person, but there's so much behind the scenes going on. I appreciate your comments about teamwork, that it's not just one of you who would be talking to some of these donors, that it would be all of you, and even expanding the team to somebody else as well. Lisa had mentioned, you know, real estate attorneys, somebody else, or even somebody at the particular charities. Again, this has just been wonderful, and thank you for sharing your time and all of your wonderful knowledge with us. Thank you everyone for listening today. We had several people listening, and I know a few of you have had to move on, but we do hope that you found this information helpful, and look in your inboxes for a recording of the seminar if there's something that you were looking for, maybe missed. And also on your screen right now are our presenters' contact information. If you wanted to follow up with any of them, they have said they will welcome your inquiries. So please take that information down. And again, it will be on the seminar, that recording that is sent to you. So thank you all, speakers and participants, and I hope you all have a wonderful afternoon. and enjoy the lingering days of this late summer weather that we're having. Goodbye.
Thanks, Jennifer.
Thanks, Jennifer.